The Crotchety Old Men podcast is not a registered investment, legal, or tax advisor or a broker-dealer. All investment financial opinions expressed by or on the Crotchety Old Men podcast are from the personal research and experience of the owner of the site and are intended as educational material. Although best efforts are made to ensure that all information is accurate and up to date, occasionally unintended errors and misprints may occur. Before you invest or make any investment-based decisions, consider your own personal circumstances. You should do your own research and seek advice from a financial professional.
Well, it's another good day with the Crotchety Old Men podcast. Hi, I'm Gary Smith, one of the co-hosts of the Crotchety Old Men podcast. Joining me in the studio today, as always, is my main partner, George Crumley. Top of the day to you, George. What's going on?
Smitty, all is well. How you doing today?
Man, I'm doing exceedingly well. Since our podcast, I'm looking at the charts on the book sales. They're still going up, and to the right. So that's a good thing.
Good. Excellent. Excellent.
So we always want to celebrate success in that endeavor. But
Absolutely.
Hey, and so in reading and things like that, continue to increase my knowledge. And along the way, George, I try to manage to play a game of golf here and there.
Hey, that's always on my schedule. The top of my list is playing a little golf. That
Absolutely.
challenge, it keeps my mind sharp, keeps challenging me. So yeah, I got to have those challenges in life.
Absolutely. So what do we have on the topic for today, George?
Spinny, as I was thinking, a lot of people, well, including us, we're wondering, what can we do to maintain our lifestyle during these times when everything seems to cost so much more. I mean, a dozen of eggs is so expensive. Food is so expensive. Going to a restaurant. So I just thought that we talk about that and lay some nuggets out and hopefully provide a little information to folks to kind of reassure them that, this too shall pass because we've been here before. We're a little older. We've seen this, but with our listening audience, wide range, young folks, middle-aged folks, older folks, they may need that reassurance that, what's really going on. Because if you just constantly focus on what's going on in the news, it's like doomsday is just around the corner. But I've never been a subscriber to that. And I thought we'd talk about that today. What do you think?
Hey, man, that's a great topic, great subject to discuss. You hit all the bullet points there because it is top of mind of a lot of people. There's so much confusion going on in the world anyway. And then when it comes down to finances or the economy, and to your point, George, it depends upon which tea leaves you're reading. One says doomsday tomorrow, and next day is, hey, it's still an opportunity to make hay while the sun shines, as we used to say. So, hey, let's dive into it.
Oh, great. Yeah, one of the first things I want to talk about is, and if you've heard our podcast before, we've always talked about a plan. So during these times, that's my first point, is stick to your plan. If you're young, you're still working, you're saving, stick to that plan. If you're approaching retirement, continue to stick to your plan, whatever it is. I think that's the most important thing. Stick to your plan. Maintain a spending level that is comfortable to you. Don't overspend, buy the things that are necessary. And then think about maybe not doing some of those things, some of those nice to have things. One of the things personally I've done is cut out going to music concerts. They seem like they've gotten so expensive. I appreciate some of these artists. A lot of them I've seen before. As you know, I'm a lover of jazz, but when it comes to spending that kind of money, me and my wife go, we're spending $200, $250, $300, in one evening. So, that in itself can add a lot back into your budget. So not saying, that's what you need to cut out, but just think about, some of the things, some of the nice to have things that you're doing in your spending habits, and maybe cut back on a few of those things.
Sure. I mean, that's a great point. You look at areas where you can cut back. We're not saying that you don't have to go, cut out going to concerts totally. Come on. We're still talking about enjoying life, but hey, there's a bunch of concerts that come through in the summertime. And if you're spending $200-300, like you say, it's an outing. Yeah, the tickets even nowadays are 75, $80, and times two, you're at 200 already. So yeah, choose those things. And I look at it like this too, George. Treat yourself almost like as though a lender would. What I mean by that is that use the DTI, debt to income ratio. All right, don't get more than a certain percentage of over in debt by putting on your credit card to buy these type of tickets or to buy those what I call impulse items. Okay, or you make those impulsive decisions to buy something that you really don't need it. You just kind of want it because at that time it flashed and you thought it was something that you really wanted or needed. But that's an expense that if you're not careful, you'll end up having a lot of those type of expenses. And then when you look at that total number to your income, you start saying, well, whoa, I'm spending maybe above the, let's say 15% of my monthly income. You may allocate 15% of your monthly income toward entertainment. All right. Now that's going to include getting an ice cream cone to going to see whoever you like to see. Try to stay within those limits. Stick, going back to what you said, George, stick to the plan.
Right. Yeah. I mean, if you listen to any of our earlier episodes, we always talk about putting things in buckets. And here again, if you put a, vacation bucket, and then so that when you schedule your vacation, this is the money I'm going to spend on my vacation, big, small, or indifferent, whatever it is, this is what we're going to spend. So
Right.
if you keep doing things like that, planning things, then you still enjoy yourself. You still do the things you enjoy doing, and then here again, you stick to a plan. That's the most important thing. Stick to the plan.
Absolutely. I kind of relate that to myself as far as golf. As we all know, those of us who play golf is an expensive game. And, while I would love to probably play, but, well, I mean, the body probably won't handle every day. But, at one time here, I was playing golf sometimes, well, at least 3, 4 times a week at times. And I started looking at that and said, whoa, that's a lot of money in golf fees and golf balls and, you name it, all the other ancillary expenses and things that we consume on the golf course. So, that stuff starts to add up. And I think, either you're going to have to buy a golf club or you're going to have to cut back on some of those golf outings. And so I still have as much fun. I just don't go quite as often. So instead of going 3 days a week, now I've cut it back to maybe 2 days a week.
Oh yeah, yeah. I mean, there's a lot of deals out there. Like I said, we just went to Nashville and we played. It was four of us, and it cost us $42.
Yeah.
It was nine holes, but I looked on site and found a deal.
Mm-hmm.
It averaged about $11 per person.
That's it.
That's like the cost of going to the driving range. So
Right.
there are some deals out here. You just got to look for them.
Just gotta
Look for
look
the deals, look for the budget. And I always drop the senior card. What's your
all
senior
the
rate?
time.
You
That's
know,
right.
yeah.
That's
So
right.
yeah,
Leverage those things.
absolutely. So
Yeah.
let's switch gears a little bit. We talked about savings, and I just want to kind of reiterate to our audience, if you haven't done this, we've talked about it before, is look at investing in a whole life insurance policy. And here again, this is a multi-tool document, or that you can use throughout your life. I mean, there's the this old saying that you're buying a death policy. Yeah, you are, but it can also be used while you're living. People say, buy term and invest the difference. But term insurance is like renting. It's going to be good for 30 years and then it's gone. And I've known a lot of, in fact, I was talking to one of my relatives and he's saying, yeah, my dad outlived his policy. So what happened when he passed away? He didn't have a policy. And a lot of people don't know that term policies do. That's why they call them term policies. But a whole life policy can not only give you that assurance of the death benefit, but it also can give you a living benefit, which is the savings, the dividends that it pays, and the savings that you accumulate during the life of the policy. So, if you're in your early learning years, that's something definitely you want to look like. And I'm not talking about getting $1 million policy. You can get a reasonable policy where your monthly insurance portion of it, is less than $100, $60, $40, depending on where you are. But the other part is your savings. You can add as much to that as you want. So, that's kind of where I wanted to go with the rest of this conversation.
Yeah, I call it like the dollar approach or the income approach when it comes to insurance. I've always pretty much said that you buy as much insurance as you can afford, and so if your dollar amount is $100 a month, whether it's your savings or whatever that number is, then that number is going to buy whatever insurance it is. All right. So depending upon your age and your health and things of that nature, certainly if you're to have a modicum degree of health and you're in your young accumulative stages, see, I look at the accumulation stage as that stage between 25 and 45, really, because those are your strongest earning years. I mean, sure, after 45, you're still earning some things, but you're kind of about to plateau at that point. But between 25 and 45, not only is it your accumulation stage, you should buy as much insurance as you can possibly afford. All right, because for two reasons. Number one, you're going to get a larger amount as far as they said the death benefit, but I look at that differently too. But you give your chance more time to accumulate money. That's what George is talking about. As far as the savings of, we're not just talking about saving some money in a piggy bank or a jar somewhere that's not earning any interest or anything. No, saving is you're putting that money to work, and it's in a cumulative stage, whereas that the money is making money, which is making money. That's called the compound interest effect. Life insurance gives you that. Now, the beauty of it is that you're insuring that investment portfolio because your goal is to continue to sow into your policy for that 20-year period or what have you. And your family is dependent upon you to be successful in that. But let's say, for instance, in the event that you become disabled, even, or something happens to you where you pass before that time that you've finished saving, that money is still there for the intentions that you originally had it for, and that's the betterment of your family. Because let's face it, y'all, most of the time that we do these things, it's for the freedom that it has, not the money that it brings.
Well, yeah, I mean, that's the whole thing. And I'm going to say I'm, one of the fortunate ones. I was instructed to buy one of these whole life policies early on in life, not knowing what I was buying, but, and just would, sock the money away, pay it every month, not thinking about it because, here again, I'm thinking it's more of a death benefit. And heck, I looked up one day and I had, a nice sum of money, so now if you think about it, in a term policy, like I said, you keep that for 30 years. 30 years, it's gone if you outlive it. So say you're, 30 years, you buy it, you're young, you're 65, you've had this policy for 30 years, it's gone. But if you had bought a whole life policy 30 years, now you've got a sum of money that is no longer needed for protection because you got a house and everything else. Your kids are all grown and gone. So, now it's just a burial policy that you need. So everything, all that cash that you've accumulated, hey, you can do whatever you want to with it. We talked earlier about vacations and splurging. I mean, you can access that in two ways. You can either borrow from it, which means you pay it back, but you pay yourself back at a modest interest rate, sometimes 4%. That means that goes back into the pot and you can use it, but don't, so that becomes a vehicle of almost borrowing from yourself. You become your own banker. If you don't want to pay it back, you have that option too. You can take a withdrawal. You take the withdrawal, the only thing that does is reduce the face amount of the policy, which heck, you don't care anyway because of the fact that you don't need that much to bury yourself, and like I said, you don't really need it for protection. So look at all this cash you've accumulated. And one of the things, I'm kind of leaving that for the end as far as the icing on the cake. But anytime you access that policy, it's tax free. Do I say that? Do I need to say that a little louder? It's tax free.
Say it again, George, so the people in the
Tax
back can hear you.
tax free. You don't
Tax.
pay a tax on it if you borrow it. You don't pay tax on it if it's a distribution.
Right.
So those things are very important. Very important.
Understanding the rules of the game enables you and positions you to play the game to win. And and I look at it like this: business is just a game, but money's how you keep the score. And we all know the old adage that it's not about how much you make, it's how much you keep. Life insurance policies enable you to do just that. Not only make the money during the accumulation stage, but during the conservation and preservation stage, it has so many tax benefits. And And for my investors out there, as well as my business owners, life insurance, specifically for my business owners out there, can be the nest egg that you're looking for in the event of you looking to expand. There's so many small businesses out here right now that are either being crushed on the one side because a lender won't loan you any more money to do your expansion or upgrade your equipment because maybe you exceeded your credit line. If you had a life insurance policy, that policy could serve as your parachute, if you will, to get you out of a situation or to give you an opportunity to get to accumulate or buy more properties or to buy more businesses, whatever that situation is. Lastly, is your insurance or your company should own some insurance, as far as key person insurance, key man, key woman insurance. Those type policies have a tremendous benefit in the event that if you're in a partnership with someone and that person either decides to move on because of a disability or death or what have you. Now you're not put in a position where you have to sell your business or mortgage your business away just to pay off your partner's spouse or what have you. Because of that insurance, you're able to do it with tax-free dollars and move on and continue your businesses. So think of this in those instances too. Insurance has a lot of benefits that supersedes just on an individual level. And if you have a business out there without insurance, and I'm not talking about property and casualty, if you protect your buildings and equipments and airplanes and cars and stuff, then you surely should protect the principles of that business that's behind the generation of wealth to begin with. So don't think that we're just talking about insurance for individuals.
Yeah, I mean, and also don't think that we're not saying invest in your 401k, invest in your Roth, invest in all these other vehicles. What we're saying is diversification, invest in all of them. 'Cause let me give you an example. So say for example, if you just invested in 401k at your job. And there's a couple things that you need to look at. So number one is if you're a high earner, okay, at some point during the year, you're going to meet the government threshold for investing in that 401k. So what does that mean? You can no longer put money in that 401k for that year. Everybody, based on how much you make, has a percentage of how much you can put into a 401k. So at some point, that may become a situation where you can't put it in for the rest of the day. Does that happen in September, October? Does it happen in July? It just depends on how much money you make. But there are limitations based, set by the government on how much you can put in every year in your 401k. Number two, what if you have an unexpected expense? Or say you want to get married or you want a destination wedding or something. Do you tap into your 401k if you don't have any other savings? And a lot of people are like that, you know. But if you tap into your 401k, guess what? There's penalties involved, you know. Number three, if you make that withdrawal, that's a tax action. That means that you're going to have to pay taxes on that money that any kind of deferred account that you tap into, you got to pay taxes. So those three things right there, you got to be aware of. But if it's life insurance, you don't have any of those. You just pick up the phone, call the policy holder, and say, "Hey, I need a couple thou," and he says, "Who you want me to make that check out to?" You decide if you want to pay it back. You decide if you don't want to pay it back. So that's the beauty. Get started early. You want to look at maybe a runway of about 20 years. 20 years into a life insurance policy will give you a very comfortable cash accumulation that will last you the rest of your life.
Now, I know my young folks out there, my millennials and stuff, look at 20 years as being a lifetime. But trust me when I tell you, 20 years go by like that. Especially those of you who are 25 now. You remember when you were 5? Look how so fast that time has gone by. The next 20 years are going to go by even faster. So don't think that we're sitting here because, we're the crotchety old men and we're telling you about 20 years and you're thinking, oh my God, that's ancient. But no, just put it away. Don't think about it. It's just like money that you jerk off when you're going to play lottery tickets or whatever people throw money away at, or you're buying cigarettes, whatever the stuff that you guys have your vices, whatever. But put those monies away. Identify a number or dollar amount that you're going to stick to. We're going right back to the premise of this podcast. Stick to the plan, no matter what. If you're going to put 10% of your money aside every paycheck, then put that 10 cent away every paycheck, in addition to what you're having deducted out of your check in your 401k, because you don't pay taxes on that money. So it makes even more sense, particularly as you're young in your cumulative stages. Put as much money in that 401k as you can. Specifically, if your employer is going to match it, oh heck, if you're saying that I can put in 5%, but you're going to match that five, which is 10% of my income. That's 10% I don't have to pay taxes on now. I can defer that. Oh yeah, I'm going for the max. Leverage that. Use leverage for your benefit.
Absolutely. And let's skip ahead a little bit. Say you followed this plan. You're now at the age of, enjoying the fruits of your labor and in your so-called retirement. And we'll use that loosely because, you still have a lot of things going on, whatever you're choosing to do in life. But this is what a diversified portfolio can do for you as far as reducing your tax liability. So if your diversified portfolio is inclusive of mutual funds, which is taxable non-qualified plan, which is mutual funds, which will be taxed when you withdraw. A tax advantage whole life policy, which is we talked about is no tax, and then tax deferred account such as your 401k. You can reduce your taxes in retirement probably about 30%. That's a lot. That means 30% back in your pocket. And I'm using these terms loosely. Obviously, it depends on how much money you're withdrawing and how much money you're taking out. But the tax saving is significant based on if you didn't have a diversified portfolio and you were taking all of that money from tax deferred accounts. Because when you take money from tax deferred account, all of that money is taxed.
Man, that's good stuff right there. It just kind of takes me back to an old adage that it's better to stop a dollar from going out than it is to create one coming in. And it took me a while to understand what that really meant. But it goes to your point about the tax savings, reducing expenses. If you can save on taxes or reduce your tax amount, then you're definitely reducing your expenses, which increases your value. All right. And all that comes, all you have to do with that is just educate yourself. But more importantly, and we definitely want to say this, we say it in our disclaimers anyway, but always get your questions answered from a certified public accountant or an attorney or a financial planner or a life insurance agent. We're not here to disperse, give you investment advice or whatever. What we're doing is giving you investment information. Okay, information that we've gleaned and learned and have experienced on our own, and all we're doing is sharing that information. So there's no advice being given here. Always seek counsel, seek accounting advice for accounting issues, and seek, ferret it out for yourself. But the best investor is an educated one. So we want to put that out there. But hey, what else we got, George?
Well, I think, we basically come for full circle because we started out talking about, how to continue to enjoy life in a manner which is, comfortable in these times where money is tight. And what we're saying here again, if you prepare early, then later on, you will have a cushion where you can still enjoy life to its fullest. And that's what we're here for. We're here to, like you say, share information, educate you, expose you, and give you opportunity. And if you're not taking advantage of the opportunity of investing in a whole life policy, you're missing a great opportunity. And don't be short-sighted and thinking that, I'm living just for today, because, God willing, and you keep eating those vegetables, you're going to live to be a ripe old age just like we are. So it's great to be in this ripe old age and be able to enjoy money, enjoy life, things like that. And it's nothing wrong with extending the time that you work. I talked to a lot of relatives here recently, and they're, my age and maybe a little younger. And I asked them, so when you going to retire? 68? I'm going to work another 5 years. How old you be? 72? Hey, if you're comfortable, you've got the health, I don't see why not. But while you're doing it, keep socking it away and putting it in diversified portfolio plans, and hey, be ready for when you do stop. So it'll be comfortable. Don't feel like you have to do it.
Here's one thing I've come to notice also. I know in this age generation, the 21st century, the 45-year work program and retire at 65 is probably gone with the covered wagons. We're not so naive here and sitting here thinking that everybody's going to work 45 years and wait till 65 to retire. Retirement is not a age. It's not a number. It's an amount. All right. You can retire at 5 if you got enough money to give you the freedom to do so. Okay. And I understand that. But for those of you who may not have that plan, if you got a plan where that you're going to retire at age 30, 35, I see it every day, all day long, people having the ability to do that. So I think the term retire or retirement is going to take on a whole different meaning as we move forward and continue to evolve in this world. Because just if you look at just the last 20 years and you look at the Forbes Fortune 500 companies, over 60-70% of them that was in the top 10 don't even exist anymore. So I can see the evolution. But at the same token, you still want to put money away. You still want to start investing now. Invest early. Other ethnic groups and stuff, they teach their kids and their families and stuff. They pool their monies together. They invest those monies into businesses. They invest those monies into insurance policies and things that generate more money. We're talking about right now. The only reason we talk about money is because of what money provides. It provides the freedom to go on vacation, the freedom to have family reunion, the freedom to play golf. It's the freedom that you want. Because let's face it, as soon as you get $1, you can't wait to spend it. So it's not the money you want. I mean, a lot of you giving it away before you even get it. So we already know that psychologically you don't want the money. What you want is what the money provides. Freedom. Stick to the plan.
Good stuff. Good stuff. So, I mean, that brings us to conclusion. I mean, we've kind of hopefully given you some information that's going to not only help you now, but help you in the future. So, hey, get with a professional, seek the information from someone that does this for a living, get the facts, and find out where you fit in. So hey, I think this concludes this podcast. I mean, I think this is probably one of the most important podcasts that we've done based on the state of affairs of everybody, and hopefully they'll listen and understand exactly, because like I said, I consider myself one of the fortunate ones that did follow this plan when I was young. So I've got that whole life policy, and it's helped me tremendously, and it's still helping me day in and day out. So, and it's figured right into my budget. So what you got to send us home with, Gary? Send us out with what you got.
Well, don't be scared. Okay. Well, number one, don't be scared, because scared money don't win. All
Nope.
right. Look here. Here's a quote. If you don't take a risk, you will always work for someone who does.
Very
okay.
Good. Very
Start
good.
taking risks. Okay. Don't play it safe. Nobody just saves money for the sake of saving money. You save money for the sake of making that money make money for you. And so there's a risk in everything. But if you don't take the risk yourself, you'll end up working for someone else who does. So with that, we always like to say, now, if you didn't know,
now you know.
All right.
Take care. Be blessed. Peace.
This is Dr. Paul Clemens with the Crotchety Old Men Podcast. If you're interested in financial tools to build wealth, and you're interested in ways to maximize your health through holistic alternatives, then you are just the audience that we're looking for. Tune in each week, every Thursday, to the Crotchety Old Men Podcast, where George Crumley, Gary Smith, and I offer you in-depth discussions on health and wealth. Subscribe to the Crotchety Old Men Podcast on Google, Spotify, Apple, iHeartRadio, or wherever you get your favorite podcast.